Hello students, so welcome to our financial planning sessions. So till last class we were discussing about cost and management accounting. We closed with the learning curve, that is the last topic, and now we are starting with the financial planning and analysis. Okay, so we will go to the ratio analysis. So that's our first chapter. Let's go inside that, for which there are a lot of formulas that is required. First, let's discuss for 5 to 10 minutes about what are all the very important formulas, and then we will go to some example problems also. Okay, so let's move on to the formula. Okay, so what is the first thing is profitability ratio. So what is profitability? Now you are a finance executive of a company, and your management is asking what is the profit ratio of the company. So what are all the profit ratios that is there? Okay, well known profit ratios or gross profit ratio. So GPR is gross profit ratio, NPR is net profit ratio. So let me just use a pen here. So GPR is gross profit ratio, NPR is net profit ratio, operating profit ratio. So you can also call it as OPR, which is operating profit ratio. Oh, this is operating ratio. So it is an operating cost. There is an operating profit ratio also. So these are all profit based ratios. That's why we term it as profitability ratio. But there are some more ratios. PE ratio. PE ratio is widely used ratio by all stock analysts. Okay, so if you are a trader in the share market, for analyzing the fundamentals of a share before you are going to invest on a particular share, you will see what is the PE ratio. So what is PE ratio? P means price, E means earning. So price of a particular share divided by earning of the particular share will give you the PE ratio. So what is the market price of a particular share? That you all know. If you are a share trading person, or any share will have a particular price. So that is the market price. So it will be trading in a particular price in the stock market. Okay, maybe in the Nifty or BSC or NSC, it will be trading in the listed companies shares will be trading in a particular price, and that is called market price. So numerator is very clear. So market price is very clear. Then what is the earning per share? So you know all the P&L right from the sales, COGS, you will get the gross profit, you will reduce all the operating expenses, you will get operating profit and all other expenses, and you will get the net profit. And after the net profit you will give the dividends. Okay, and you will pay the taxes, you will pay the interest, you will pay for the depreciation, and finally you will get the profit after tax, or you can say it as the earnings, and that earnings divided by the total number of shares will be the earning per share. So the denominator is earning per share. So price divided by earning per share, price per share divided by earning per share will be the PE ratio. Next is the gross profit margin. We all very well know what is the gross profit as per the P&L divided by the total sales, net sales. Okay, same way the net profit is net profit as per the P&L divided by the net sales. So that is net profit ratio. So we are very sure about the net profit ratio, and we are very sure about the gross profit ratio. There is no doubt at all. Operating profit ratio is operating profit divided by sales, but here it is operating ratio. So what is operating ratio? Operating ratio is nothing but operations. You have to control your operations. So how you can control your operations? By controlling the cost of operation. How to control the cost of operation? By putting a ratio like this. What is the operating cost? Okay, my factory's operating cost, what it is, divided by sales. Okay, you can do maximum only 5% of your sales as operating cost. Do not go above that. You as a financial accountant or cost accountant placing stringent bars for the operation, or else they will consume left and right, and in the end of the month closing you will not have any margin at all. So this is for controlling the cost. Okay, so indirectly it is benefiting your operating profit or net profit. That's why it is coming under the profitability ratio. Next is FCCR. What is that? Fixed cost coverage ratio. Fixed cost coverage ratio. So income before interest and tax. So what is your earnings? Income is nothing but earnings as per P&L, earning before deducting the interest and before deducting the tax for the current year. So that is the income before interest and tax divided by interest. This is not for the company in which you are working. This is for the lender, for that company that some banks would have given the loans. Okay, and that bank will verify you whether you are having a good FCCR or not. Then only they will top up their loan given to the company. Okay, now how that bank will verify your company? So whether you have the ability to repay your interest. For example, income before interest and tax is 1 lakh and interest is 10,000. 1 lakh divided by 10,000 is 10 times. Okay, this guy or this company is having 10 times the income, so he will have the ability to pay the interest. So I can top up or give more uh, loan to him, or my existing loan he has the capacity to repay. There is no risk for me to get the interest from this particular company. That is called FCCR. Next, what is that? That is payout ratio. From the name itself, we are paying out something. What we are going to pay out? Dividend we are going to pay out for the shareholders. So dividend per equity share divided by earning per equity share. So earning per equity share is the total earning of the company for that share, and out of that you are going to pay out something as dividend. That's why it is called payout ratio. So if, for example, is the 10 rupees is the earning for you and 1 rupee you are going to pay the dividend to that shareholder, 1 divided by 10, which is 10% you are paying out. That is payout ratio. Next is dividend yield ratio. So what is yield? Yield means, for example, you are putting your sum of money in the fixed deposit. Okay, so 1 lakh rupee you are putting in the fixed deposit and you are getting an interest of 10,000 rupees for the year. So 10,000 divided by 1 lakh rupee is 10% returns you are got. The same thing is here. Here you are going to buy the share. How you will buy the share? You will buy at market price. So market price is your investment. So that is the amount you have invested, and what is the return you have got? Dividend is the return you have got. So dividend per share divided by market price per share will be the dividend yield ratio. Perfect. So next is activity ratio. So what activity means? The company is doing some activity. What is the end product of the activity? You are going to achieve some sales. So anything that is touching the sales, so most of the ratios will be touching the sales. Those are all activity ratio. So first thing is overall turnover ratio. What is this overall turnover ratio? Turnover means it is sales. So net sales divided by capital employed. For this size of capital, what is the sales you have got? Okay, and you can compare your company with some other competitive company, whether that guy is using lesser capital and generating more sales. Then you have to focus on why that is happening. Okay, whether I have put my capital in unwanted fixed assets or why this is happening, you can do that analysis. This is very important parameter. Next, fixed asset turnover ratio. So fixed asset is one component, turnover is sales one component. So sales divided by fixed assets. So net sales divided by fixed assets. So what is that? Here also you can compare your company with another company, or for your company itself. In last month I had a ratio of net sales divided by fixed assets of 2, and this month I am having 2.5. What does this show? Your fixed assets turnover ratio has gone up, means your sales has gone up. Okay, your sales has gone up for the particular fixed, which is good for the company. So which means you are putting the fixed assets into utilization better way. In a better way you are using your fixed asset. That's why for the same fixed asset you are generating more sales, or there is an increase in the fixed asset. There is no issue, but the ratio has increased, which means a proportionate increase of sales from one month to other month is more compared to the fixed asset increase. So that is the fixed assets turnover ratio. Next, debtors turnover ratio, creditors turnover ratio, and stock turnover ratio. These three are very, very important. You may get in an objective type also. You may get in a very small 2 mark, 3 mark, 4 mark problem also. Okay, so debtors turnover ratio. What is debtors? Debtors is in the side of assets. Okay, any customers for which we have delivered our product and they are going to make the payment maybe 10 days later or 20 days later or 30 days later. that is the credit, that is the debtors, which means it is your assets. Okay, so which means you have done credit sales. Okay, if you have done cash sales, the cash would have immediately come to your account and your cash balance would have gone up. Whenever you have not done cash sales, which means the customer will pay you at a later date, and that is called credit sales. Okay, so credit sales, whatever is the credit sales divided by average accounts receivable. So for a particular month, you want to calculate the debtor turnover ratio. So for that month, what is the credit sales that you have done divided by average accounts receivable, that will be given in your question. So that is an average accounts receivable that is calculated for that period. When you divide this, it will give you the debtors turnover ratio. So how significant it is, how much time this is higher, that is better for us. Okay, so for at the okay, so that much time the debtors has been come in and we have realized it, realized the cash. So there will be a specific team who will follow up with the customer to realize the payment as soon as possible. Okay, so that is called debtors turnover ratio. Okay, so for this debt collection period, so there is one more parameter which is debt collection period. So for that month, average, what is your collection period? So how your collections team has performed. You would have fixed the metrics for them. You have to achieve all the collection in 10 days from the sales. So whether they have achieved or not, whether they have done a good job or not, can be analyzed from this. Okay, number of months or number of days in a year or that period divided by the debtors turnover ratio, which we have calculated here. So this same debtors turnover ratio is coming here. Okay, this is coming here, debtors turnover ratio. So that is debt collection period. Okay, so debt collection, so if it is very less, which means the company is converting the credit sales into cash as soon as possible. The collection team is working in a very good way. Okay, the exactly the same thing applies for the creditors turnover ratio. Credit purchases, you have bought something from your suppliers or vendors and that is not an immediate payment, you are going to pay them at the later date, and that is called credit purchases divided by average accounts payable. So here it is average accounts receivable, here it is average accounts payable. Same way, credit period enjoyed, who is enjoying it? Our vendor or supplier is enjoying it. So months or days in that period divided by creditors turnover ratio. So this ratio is taken here. Same way. It's also perfect. Okay, so that is credit period enjoyed. So if the credit period enjoyed is very high, which means you are not promptly, it may be you are not promptly paying to the vendor, but it may be good also because your cash flow is not affected. You are going to pay and you are going to pay them as late as possible, then it is good for you. But as per the terms and conditions, you should have paid. Okay, so 60 days is the time given by the vendor to you to make the payment. Then you can and your credit period enjoyed is only 20 days. Okay, you are paying so early, what is the use of it? You could have used that money for something and then you would have generated some sales, and that cash you could have used for paying to your vendor at the later date, maybe 45 days later or 50 days later, because 60 days terms is there. So this is a very important criteria, considering the liquidity of the company, cash flow of the company. This is very important. It may be asked in your interview questions also. Okay, so prepare that very well. Stock turnover ratio is also in interview questions. Most of the interview will have this question. So COGS, you all very well know, cost of goods sold divided by average inventory. What is average inventory? Opening inventory plus closing inventory divided by 2. It is the average inventory. You will divide the COGS by this, and whatever is the stock turnover ratio. Higher stock turnover ratio, it is good for you because that much time the stock has come in and stock has been converted into sales and it has gone out. So that much margin you would have generated. So which means higher stock turnover ratio is very good. Okay. Okay, so what are all the other ratios that is there? Yes. So long-term solvency ratio. So long-term solvency ratio. So which means long-term things are going to come here. Okay, fixed assets ratio. Fixed assets ratio. We have seen fixed asset turnover ratio, that is an activity ratio, but here it is a long-term solvency ratio. So net fixed assets divided by long-term funds. Fixed assets you can get from the balance sheet. Long-term funds, what is the long term fund? You would have got a long term loan, you would have a long term debentures, you would have also a equity share capital. So all these things are long term capitals. So this is long term fund. They are going, all these people are going to be a long term investors. Okay, so fixed assets divided by long term funds will give you the fixed asset ratio. Next is debt equity ratio, which is very important ratio. There is two formulas to calculate debt equity ratio. Whichever is relevant, the respective company will use. Okay, but it is you as a financial accountant should propose to management. These are the two ways in which you can calculate debt equity ratio. Okay, first thing is debt divided by equity, that is called debt equity ratio, number one. Number two is total long term debt, that is in the numerator, total long term debt, that is in the numerator. So in the both the formulas, debt will be in the numerator, no confusion. But in the denominator, equity, shareholders fund is otherwise called as equity. What is shareholders fund? Equity share capital plus preference share capital plus general reserves, if any. All these are shareholders fund. Okay, so debt, long term debt divided by shareholders funds will give you the debt equity ratio. Otherwise, you can also divide it by long term funds. What is long term fund? Shareholders fund is also a long term fund. Shareholders fund plus long term debt. Okay, putting together, long term debt is there in the numerator. So shareholders fund plus long term debt, that becomes a long term fund. So long term debt divided by long term fund can also be said as debt equity ratio. So whichever is useful for your industry, you can use it. Okay, proprietary ratio. Okay, proprietary ratio, shareholders fund divided by total tangible assets. What is tangible assets? Total assets minus intangible assets. So what are all intangible assets? Goodwill is an intangible asset. So same way, those intangible assets can be taken out and tangible assets can be calculated. Shareholders fund, which we discussed now, divided by tangible assets, okay, is going to give you the proprietary ratio. Okay, proprietary ratio. Next is financial ratios, short term solvency ratio. So what is short term solvency? Current ratio. Every problem will have a current ratio. Almost you will get a current ratio for sure. So current ratio is current assets divided by current liability. What is current assets? Any assets, you any asset which will have a term less than 1 year is called a current assets. Okay, so what are all the examples of current assets? Cash, yes, you can realize it and use it anywhere within a year. Okay, it is a liquid, highly liquid, it's a current asset. Next, inventory is a current asset. Okay, inventory will be used for the production, it will be replenished, so there will be a keep on movement in the inventory. Inventory is a current assets. Okay, so these are all the examples of current asset. What are current liability? I missed in the current asset. Debtor is a current liability, current asset. Okay, creditor is a current liability. Okay, taxes for the current year which you are going to pay out, that is a current liability. Dividend which has been declared or proposed dividend, which means you will be paying in the next 4 or 5 months, so that will be a current liability. So these are whatever you are going to pay out, okay, in the next less than a year, that is going to be current liability. Current assets divided by current liability is going to give you the current ratio. What is liquidity ratio? Liquidity ratio is liquid assets divided by current liability. Liquid assets divided by current liability. Okay, sometimes current liability may include bank overdraft. At that time you have to take the bank draft overdraft out. Okay, that will become liquid liabilities, which we will see in the problems, upcoming problems. So liquid ratio is liquid assets divided by current liability. What is liquid assets? It is very simple. Current assets will include inventory or stock. If you eliminate the stock from the current assets, it will become liquid assets. So liquidity ratio is done. Next is super quick ratio. What is super quick ratio? Super quick ratio is Super quick assets divided by current liabilities. Whatever is in the cash or cash form. Okay, you may have some marketable securities that can be immediately sold and realized cash. So that is quick asset. Okay, anything that cannot be converted immediately for my debtors you have to follow with the customer to make the receive the payments, receive the collections for your sales, so that may take time, so that is not a quick asset. So quick asset is cash or cash form. Okay, only that will be the quick assets divided by current liability. Next is debt service coverage ratio. So debt service coverage ratio. So what is that? So the ability for you to pay off your debt. Okay. So profit after taxes, add the depreciation, it's a non-cash expenditure, plus interest on the loan divided by interest on the loan. Okay. So which means your interest on the loan is 10,000 rupees. Profit after tax is 1 lakh. Okay, and 1 lakh plus 10,000 will be 1 lakh 10,000 in the numerator divided by interest on the loan is 10,000. So 1 lakh 10,000 divided by 1 lakh, which is equal to 11. So 11 times your interest is protected. It's good for you. Yes, I will have the ability to pay my interest for the loan I have taken. Okay, and your lender, you can project this to your lender also. He will also be confident. Okay, yes. So we have discussed on the formulas, and now we will go for the first problem for the day. So the company has given the P&L statement and balance sheet for a particular company, and they want to calculate the ratios. What is the ratios? Lot of ratios has been asked. So the P&L statement is given, balance sheet is given. Now what we need, okay, is gross profit ratio. Can we find the, okay, the P&L is given as debit and credit. So we have to frame the proper income statement. So what is proper income statement? The sales is the first item of the P&L. Sales is given as 10 lakhs. Next is the cost of goods sold, for which we need the raw material consumed. Raw material closing stock is given here. Raw material purchases is given. Raw material opening stock is given. So opening stock plus purchases minus closing stock is the raw material consumed. I have taken it here. Next, wages is given in the question. Okay, so for manufacturing we have to pay the wages for the labors, and for manufacturing expenses we will have a lot of electricity and other stuffs, and manufacturing expenses we have paid, and finished stock is generated, and adjustment on the finished stock, what is that? Add the opening stock of the FG and minus the closing stock of the FG. Okay, so both are 1 lakh, so that will set off each other, and total COGS comes to 5 lakh, and sales minus COGS is the gross profit, which is 5 lakh. Okay, so from which gross profit ratio we can easily calculate. So gross profit divided by sales is going to be the gross profit ratio. Next is, what is the operating expenses? Administration expenses, yes, it is your operation, and selling and distribution expenses is your operation. You are taking it as an operation expenditure, and you are reducing this operating expenses from your gross profit, and you will find the operating profit. Now what are the other items? You have some loss on sale of fixed loss on sale of plant, and you have some interest. Okay, you have some you have some non-operating income of 50,000. You have a profit on sales of share 50,000. So these are all not related to your operation. So adding your operating income and reducing your loss on sale of plant, this is giving you a minus 5,000, and you are reducing it from the operating profit, and you are finding the earning before interest and taxation. So what is the interest? Interest on the debenture, which is also given here, which is 10,000. Reducing the interest, you will get the earning before taxes. You can also say it as net profit. So net profit margin also you can calculate here. Net profit divided by sales is the net profit ratio. So very simple. Next, what are all the other ratios? Current ratio is asked, so you need to calculate current assets, current liability, which we discussed just now. So now we are going to, I'm taking it as position statement. Position statement is otherwise called as balance sheet. Okay, so I'm retrieving the data from the balance sheet. So what are all the liquid assets that is there? So bank balance is your liquid assets. Okay, debtors, yes, that is your liquid. Anyway, in 10 or 20 days, your customer is going to pay this amount. So that's the liquidity. So that is your liquid assets. So liquid assets is 1,50,000. Perfect. Next is inventory. Okay, inventory is not liquid assets, but it is current assets. So liquid assets plus inventory of 2.5 lakhs will give you the current assets. So current assets we have calculated. So what is current liability? Current liability is creditors plus bills payable. Current liabilities is calculated here. Perfect. Next, what is working capital? Working capital is current assets minus current liability. Okay, 2.5 lakhs is the working capital. Fixed assets, it is given in the question. Why I am taking that fixed assets? Maybe it may be required for some calculating some ratios. So fixed assets is given in the question. What is capital employed? Okay, so capital employed is fixed assets. Your capital is not going to sit in you are going to invest it into the fixed assets and also in the working capital. So working capital is current assets minus current liability is working capital plus fixed assets is going to be the total capital that you have employed. Okay, so that is the total capital that you have employed. So capital employed is 5 lakhs. Next is shareholders fund. Equity is a shareholders fund, preference is a shareholders fund, and general reserves is a shareholders fund. Total shareholders fund is 3 lakhs. Super. So we have calculated all the requisites for calculating the ratios. Now we will go for calculating the ratios. So ratio problems are very simple. The main thing is don't be afraid of it. Don't please think that you may go something wrong. It will take a lot of less time to calculate compared to other problems. It will save your time. So if you master this financial analysis, you will get high probability you will get exemption in your paper, because you are going to use very less time and you will have more time for answering the other question, especially if you are going to answer standard costing, learning curve, budgeting. Questions will be very big. You will take at least 10 minutes to read the question itself. Answering will take another 20 minutes. Half an hour for one question will go. Then how you will have time to answer your objective question, because you have to read the objective question, think for a while about all the 4 options, because sometimes in the objective question you will be carried forward by some other thing and you will take a wrong answer. Just read the question, apply your mind, uh, select answer, and then read the question once again. And yes, and be sure that's the way you have to answer the objective type question, because your mind will think of some other problem and you will take a wrong answer, or you may think B is the correct answer and while shading you would have shaded D. Okay, so all this will come. So students, be very careful, because my students should get exemption. Okay, so that's the way out. Then only you can focus on the upcoming subjects very well. Okay, so let's go to the ratio calculation. Gross profit ratio, as I said, gross profit we have calculated it earlier, divided by sales. Operating profit ratio or overall profitability ratio, operating profit divided by sales. Net profit ratio they have not asked. If they have asked, net profit divided by sales is net profit ratio. Very simple. Next is current ratio. We know current assets divided by current liability. That is very simple. We have already calculated all the values in our previous, just rewind and see. We have calculated all the values. So debt equity ratio, we have discussed 2 formulas. Debt is the numerator, there is no doubt about it. Denominator may be shareholders fund or long term fund. What is shareholders fund here? We have calculated shareholders fund as equity plus preference plus general reserves 3 lakhs. Or long term funds, what is long term funds? 3 lakh is the shareholders fund. So 3 lakh plus 2 lakh of debt will give you 5 lakh. So 5 lakh is the denominator for the debt equity ratio. Superb. Okay, so next is the stock turnover ratio. Stock turnover ratio is COGS divided by average stock. So what is average stock? Here it is, they have given only stock turnover ratio. Stock, what is stock? They are the input raw material. So which means raw material turnover ratio. So average raw material stock you have to take, opening raw material stock plus closing raw material stock divided by 2 will give you the average inventory, average raw material inventory. Now stock turnover ratio, it is nothing but the raw material consumed. How we calculated raw material consumed? Opening stock plus purchases minus closing stock. Already while making the income statement we calculated it. So raw material consumed divided by average RM stock, which we calculated here. Average RM stock will give you the stock turnover ratio. Okay, how much this is more, that is better. Higher is better. Stock turnover ratio. Average fixed, average FG stock. Okay, they have also asked for finished goods turnover ratio. Very simple. Finished goods turnover ratio for which average finished goods stock, opening FG plus closing FG divided by 2. Opening FG plus closing FG divided by 2. Average FG stock we have found. Now COGS. What is the cost of goods sold? We have already calculated in the income statement. Just rewind and see. We have calculated COGS. COGS divided by average FG stock will give you FG turnover ratio. I have mentioned it wrong. This is not stock turnover ratio. This is fixed goods, finished goods. I'm sorry, finished goods turnover ratio. Finished goods turnover ratio. Next, the liquidity ratio. What is liquidity ratio? Liquid assets divided by liquid liabilities. What is liquid assets? Current assets exclude the inventory. Current assets minus inventory is going to be liquid assets. What is liquid liabilities? Liquid liabilities is current liabilities current liabilities minus any bank overdraft or whichever you cannot realize it, which is not required to be paid within within a very short term. That is liquid liability. So liquid assets divided by liquid liabilities. So in this case, current liabilities is equal to liquid liabilities. That will give you a liquidity ratio. So very simple. Only the numerator is changing here. Current assets minus inventory will give you the liquid assets. So liquid assets divided by liquid liabilities will give you the liquidity ratio. So that's it for this session. Very soon I will be coming out with the next class. Thank you. Thank you, students. All the very best.